G'day everyone, welcome to this weekly update for the 12th of October, and huge volatility in the week just gone, and you can certainly say that the correction is really on well and truly now for most places around the world, certainly Europe, certainly Australia, America, parts of it certainly in correction now, the small cap area. The S&P still a bit debatable what's happening there, but the landscape has changed quite dramatically in the last week, or it was giving indications of it a few weeks ago, but really confirmed last week. So let's have a look at the action for the week. The S&P index ended down a massive 62 points on the week. We saw a huge increase in volatility. The VIX index is up above 20, although still not as high as I would have thought it should be given the price action. So there's not quite as much fear as you would normally see with the sort of moves we had. We had 3 triple-digit gains or losses in the Dow back-to-back through the week. The S&P is now sitting on a key support level. That needs to hold, otherwise we're going lower. That'll bring in more selling. Now the Russell 2000, I indicated last week and even up until Thursday, it was holding support. The Russell 2000 broke through support and is clearly now into a phase 4 decline. Now that doesn't mean that it's a disaster. It just means that we're likely to see selling pressure now for some time. It could take several months for that to play out. Now for the S&P index, the first time below the 150-day moving average in 2 years. So last week, if you saw last week's video, which was titled The Changing Character of Markets, I looked a lot at the bigger picture character of markets, where the indexes were trading in relation to the moving average and just the general overall character. And it's significant, I think, that the S&P, the first time below the 150-day, and it did it in very, very emphatic fashion. It's too early to call a major change in the S&P, but reporting season is just starting in America, and I think that will have a huge bearing on how things go with the market. If earnings come in better than expectations, then this might be fairly short-lived correction, and we may get back into a more typical year-end rally from mid to late October onwards. It's too early to make that call. If reporting season is not as good as what the general analyst population is expecting, then we're going to see some hefty selling, I believe. Now, European indices, really significant here. I highlighted the German DAX last week. It's now clearly into a very significant phase 4 decline, and we'll have a look at that in just a minute. Just pose a couple of questions to think about. Judging by comments made by the head of the ECB through the week, who's been ultra positive all through, finally the cracks are starting to appear, and I just pose the question, has the ECB run out of ideas? Because if they are now acknowledging that they're pretty much powerless to do much unless there is significant reform in some of the countries, then if so, what are the consequences of that? What are the consequences for profits of companies in the Eurozone, and therefore demand for Chinese goods, for American goods? There's all sorts of consequences if the Eurozone as a whole is going to slip into a recession. So for me, this is certainly a medium-term short selling opportunity into the German market. And also the British market as well, the FTSE, also probably into a phase 4 decline. We'll have a look at that chart in just a minute. We only saw a weak rally for just a couple of days, so we didn't manage to claw back much of the lost ground. All right, let's have a look at the S&P first of all. So pan back and have a big picture look. You can see the last time that the index went through the 150-day moving average was the 14th of November 2012. So just a month short of 2 years. And that was really when it was just getting started. Since then, the index has not pierced the 150-day moving average all through. And you can see also last time it did it, it was only about 3 or 4 trading sessions, and it was back on top again. So it's really critical what happens. As I said, the reporting season just starting in America, that will have a huge bearing. If this index spends more than a couple of weeks below the 150-day moving average, then you've got to say the S&P is in the process of changing character. Also too, we've taken out, or not quite, we're right on support. As you can see, there's a support level through here, which picks up highs from here in April, again in May, and picks up the lows from August. Now, if that level breaks, then you will see some more significant technical selling, and we could see the S&P well down into the 1800 territory, and that would really get us into a full-on corrective mode. Next week is critical. What transpires next week is really, really important. Let's have a look at the Russell 2000 while we're on the American market. So you can see that the Russell 2000 was in very strong uptrend. If you step back, you can now see we've had a long series of top formations, and now we've broken through these lows. There was 4 or 5 of them. We broke through those lows at the start of last week. It managed a one-day rally, and as you can see, it ran out of steam pretty quickly and emphatically down on Thursday and Friday. So the moving average is now rolled over. The index has now spent enough time below the moving average, and it's taken out these lows to suggest to me that clearly the Russell 2000 is now in a phase 4 decline, and that is significant. That is not just a minor little thing to note. That is significant. The character of the market has changed. So if you're doing anything in America, you need to take a lot more care. Looking now at the German DAX, which we looked at last week. Again, you can see the changing character of that market. The 150-day moving average, the red line, has rolled over. We've formed a lower high, and now we've formed a lower low. You can see we took out these lows basically on Friday night. So up until then, you could have said, well, it's still in a sideways consolidation. But we can see what happened on Friday night. We had gaps all through the week. So an emphatic break of that support. I'd suggest to you that the DAX index is probably going down quite significantly. And we could, I think the first place to be looking at is probably down around this, there's a possibility we'll find some support around the 8,500 mark, 8,520, but more likely we're heading towards 8,100, or possibly, depending on how bad the economics get, we could even get down into the 7,500s for the German DAX over a period of a few months. So not good signs there at all in Germany. This is the FTSE index. Again, you can see it's the same pattern. The 150-day moving average now, for the first time, is now pointing down. And the index, you can see by comparison, it was only below the index, below the moving average for about 5-6 days, similar all the way through here, and now we've been below the moving average now since the 22nd of September. So this is a changing character in the FTSE as well. So significant changes in global markets, that's for sure. Looking at the Aussie market, our index fell by 130 points on the week and is now down by 8.5% from the September peak. So it's 10% is what is recognised as being into correction territory. We're not far from that. There's a strong chance we've gone into phase 4, I believe, when you look at the chart. And the key thing for me is that it would have been far, far worse except for the banks. If you look at the banking index, if you separate that out from the ASX 200, the banking index was actually reasonably flat last week, but there were significant falls everywhere else. And I think the environment for the banks is not all that flash. So if there's more selling in the banks, we're going to see the ASX 200 accelerate to the downside, I believe. Now, this is this is a slide I had up last week. I just want to put this up as a reminder. There was a key level at 50.50, but I made the point that if it gets to that level, and we're well on our way to that level now, that the damage to your portfolio has already been done. So that the analysis that I've been doing over the last couple of weeks of these big picture changes from phase 2 into phase 3 or phase 4 is not about when to get out. You should have been lightening off your exposure weeks ago. This is about how to make money in the next phase. And there's certainly some opportunities. When there's volatility, there's always opportunities gets presented. Let's just look quickly at the ASX 200. We'll look at the materials index first. So you can see it's copped an absolute hiding last week. And it wasn't in a phase 2 bull market anyway. The materials index has just been in a big sideways consolidation for a number of years, but certainly copped an absolute thrashing on Friday. If we look at the banks, you can see across, yes, they're down off their peaks, but last week finished roughly flat, maybe down just a fraction. But there's the ASX 200. So this was the chart we looked at last week. You'll notice there's two thin green bands. The first one was around 5,300, which I said was an important support level. We finished on that support level last Friday, the Friday before last, and I said if it broke that, we'd be heading down to this 5,050 mark. You can see what happened on Friday. It was a very, very large fall on Friday. So I would say it's absolutely odds on that we're heading down to 50.50. And if the banks start to really participate in this decline, then we could be looking at maybe revisiting all the way down here at 4,600. Certainly the signs in our economy, commodities, and a number of the overseas indicators to me would not rule out getting down to that sort of level. Let's look at commodities. Gold ended up $33 for the higher for the week, and that was mainly due to the US dollar backing off a little bit. Not totally. There was a little bit more support for gold, but it was mostly about the US dollar. Silver not yet recovering, so you absolutely want to stay away from buying silver, but perhaps there's an opportunity for those of you that short sell to look at short selling the rally. So let's just look at those couple of charts. We'll look at silver first of all. This is silver on a bigger picture weekly chart. So you can see that we've got really important support around $19.50. We had this big declining wedge. We had this large triple, quadruple bottom here. It broke about 3 or 4 weeks ago. Now it's possible that silver will rally back and retest the breakdown. So if you're looking to short sell, then maybe looking to short sell around about a rally back to somewhere between $18.50 and $19 could be a good short selling opportunity for those of you that are doing that. Let's look at gold on a weekly chart. You can see gold is still holding on to the bottom of that support just by the skin of its teeth. But I believe the US dollar, there's probably a lot more fundamental reasons why the US dollar will go up, which is going to continue to keep pressure on gold. So I'm not overly confident about what's going to happen there unless the US government steps in and does something to force the US dollar back down again, which I guess is always possible. Let's look at the GDX index. So the GDX index, it's still within the overall phase 1 base, so it hasn't broken to the downside yet. So gold and gold stocks certainly doing better than silver, but it's all very precarious. So for me, these are not great odds. And if we look at the US dollar, you can see the US dollar index. So this is the US dollar against a basket of currencies, heavily skewed towards the euro. Then you can see it's been a massive rally, and the fundamentals would suggest that this rally's probably got further to go. And the more that the US dollar rises, then the more that the gold price is going to remain under pressure. So in general, I would be staying away from commodity stocks and also from any service providers in the commodity industry. We've got oil. Oil price has been hit very hard, so energy stocks all around the world are under pressure. We've got nickel stocks and all your base metal stocks are under pressure. You've got iron ore. The iron ore price is been hit very hard. So wherever you look, it's the signs aren't good for commodities at the minute. We're going through a period of very significant transition. And I think under those circumstances, you just don't want to be participating, because when you've got a period of significant transition and you've got huge volatility, then you don't have an edge. The market could go either up or down significantly in very short periods of time. And the only way that you should be trading or investing is when you've got a significant edge. So when you don't have that edge, just step back and let it settle down. Copper managed to hold steady at 304, but crude oil down to 86 really had a significant belting through the week. And energy stocks all around the world have just been absolutely smashed. And we saw it here with Woodside, with Santos, with Oil Search. All the major oil companies were hit very hard, and it's the same thing all around the world. There's the spot copper chart, held steady. Nickel also has been in decline over the last month or two, but managed to hold steady on the week. So just overall, to wrap it up, and these are really more some thoughts about how you should react in these sort of volatile environments. Don't be thrown off. If you've got a good strategy, don't be thrown off that strategy by the irrational behavior of the majority of the people. And we're starting to see that now. In America, some of the really, really good stocks, growth stocks that were cheap already, are being sold off heavily along with everything else. That's just irrational behavior. Now, to make money in the market, you need to focus on buying low and selling high. Now, that's such a basic statement that it almost doesn't warrant saying, but some people do tend to forget that that's what we're about. But the key point I want to make is the only way to be able to buy low, particularly to buy good stocks low, is you have to experience price volatility. Just think about it. Good stocks are rarely cheap. So the only way you're going to get a crack at a good stock cheaply is that there's got to be this sort of irrational behavior. So if you're put off by this sort of volatility in the market, then you'll never make serious money in the market. You've got to be prepared to get in during these sort of times, but you do it in a very considered way. And the second point that I want to make, particularly for the holdings that you may still have, and you should be plenty well cashed up, but for the holdings you've still got, just think about this. Just because the market gives you a price signal every minute, every second of every day, doesn't mean that you have to react to it. The price of your house doesn't get advertised every minute of every day and fluctuate up and down. So the message here is focus on good fundamentals and good value, but at times like this, when things get really volatile, technical patterns are even more critical, because often the fundamentals don't mean anything. The market is always looking ahead. So the technical patterns are absolutely critical to read at times like this. So that's it for this week. A little bit long, I know, but just such an important transition period. Step one is protect your capital. Step two is take advantage of opportunities. Opportunities come from volatility. We're now getting that in spades, and markets are going through a transition. It's a time where, unless you're really on top of your game, then you either need assistance from someone that's been through many, many market cycles. So I'm talking to non-members of specialist share education here. Unless you've got a great deal of experience, then stay out of these kind of markets. But if you want to participate and you want to take advantage of being able to buy great stocks cheaply, then now's the time to do it. But for goodness sake, get some help. There's our website address. There's my email address. Always happy to communicate with people, particularly if you're serious about doing things properly in the market. Next week, critical, what happens in the US reporting season. So I'm sure I'll have a lot to talk about next weekend. That's it. Cheers.